Good afternoon, ladies and gentlemen, and welcome to the INSTEM investor presentation relating to the trading update for the 6 months to the 30th of June 2020. Throughout this presentation, investors will be in listen-only mode. Before we begin, there are a couple of polls that we would like to submit, so I will send the first one to you now. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the top right-hand corner of the screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. I'd now like to hand over to Phil Reason, CEO, and Nigel Goldsmith, the CFO of INSTEM PLC. Thank you.
Thank you very much, Mark, and welcome everybody. Thank you very much for attending. We're very excited today to share a little bit more about INSTEM. Hopefully you've had a chance to do a little bit of homework before joining. Nigel and I have our cameras on. We will switch them off momentarily once we've done some introductions, just to help avoid any bandwidth issues. You'll be pleased to know that I am not going to talk through the disclaimer. I'm sure you will have read many of those before. Just a few brief minutes or seconds about me. So I've been involved with something called INSTEM since 1982. I've been involved running this particular business that you're going to hear about since the mid-90s. As you will hear, this is very much a global business. Over 50% of our revenue comes from the US. So I'm actually talking to you from just outside Philadelphia. I moved to the US in 2003 because a significant proportion of our clients and prospects are here. And actually, as you'll hear, we are very acquisitive and probably 70 to 80% of our potential acquisition targets are here in the US. So that's me. Nigel?
Hi, Nigel Goldsmith. I'm the Chief Financial Officer of INSTEM. I'm in my 9th year with INSTEM now, and 20th year as a CFO. I'm based at INSTEM's UK headquarters in Stone in Staffordshire. I'm a chartered accountant by trade. I've spent 14 years in public practice, primarily with KPMG, before I moved into industry in the mid-90s, and I've spent most of my career since then in life sciences. Okay, thank you, Phil.
Thanks very much, Nigel. So as Mark said, we will be delighted if you ask questions as you go along. We have had some submitted already, so thank you to those who have already submitted questions through the IMC portal. Brief set of contents here on what we're going to cover. I won't go through all of those. That will become evident as we step through. So jumping into a little bit of an overview of INSTEM. So INSTEM is a leading provider of IT solutions and services to the life sciences market. We'll talk more about what we mean by leadership as we move on. And it is a very fortunate place we find ourselves, that every day we come into work knowing that we're enabling our clients to bring their life-enhancing products to market faster. It's not difficult to be motivated, particularly in the current circumstances, where we know our clients are using our products and our services to help with things like COVID-19 vaccines and therapies. The business is organized into 3 market-facing areas. All of these areas share in common that we're helping clients to collect, analyze, report, and submit data to regulatory agencies with the confidence that this isn't going to be rejected by the agencies, and actually is really great quality data that they don't come back in later stages of the very expensive R&D process to regret that data quality was poor early on and they could have made a different decision in their drug development program if only they'd known more earlier in the process. Those 3 areas of the business, and we'll see these positioned in a slide in a minute in the R&D life cycle are study management, where we have a portfolio of solutions that manage the workflow of the laboratory activities. And those solutions help our clients with the efficiency of the data that they collect, how they orchestrate those experiments, and the statistical analysis of the data at the end of the process. The next area is regulatory solutions. There are two aspects to this business. One is taking data from study management applications. They could be our study management applications, or they could be competitors' study management applications, and manipulating that data to get it into the format that is required by the regulatory agencies, particularly in here an electronic submission format for the US FDA. The other part of this business is involved in the regulatory submissions that need to be made once a drug or a medical device or another regulated product has been approved, and you are starting to launch that product in each new country around the world. And there are mandated formats for that data. If you are an organization with hundreds or maybe thousands of products and you are selling them maybe in 150 countries around the world, to have some IT that helps you to keep those submissions up to date and current, to allow you to launch your product quickly and to keep it on the market if any of that data changes and needs to be updated with those regulatory authorities around the world. The third area is our informatics group. And this area, the smallest in absolute terms, but one of the most exciting parts of the business. It's an area that is helping our clients look at large volumes of historic data and to derive new insights from that information that help them with today's R&D process. The life sciences research and development market, like all industries, is desperately keen to leverage large volumes of historic data to improve what they undertake. So this positions those three areas in the overall R&D life cycle, and actually beyond R&D into the marketing of those regulated products. So although the industry has been trying desperately hard to reduce the amount of time it takes to bring a new product to market, for a drug at least, it is still somewhere around 12 to 13 years from when you first register the patent on your new therapy, your new drug, your new vaccine, to bring that to market. Now, obviously, we're hearing that the desperate rush that people are trying to make to bring new vaccines and therapies to market for COVID-19, and people talking about trying to do that in months or a little over 1 year. And on the basis that the average is somewhere between 12 and 13 years, you can envisage how difficult that is. Our study management applications go from the later stages of the discovery of new drugs. They might be molecules, they might be biological interventions, through to the early stages of clinical trials. So testing on small numbers of human subjects just to prove the concept of a drug. We stop and we don't get involved when you get the ramp up of testing into thousands or tens of thousands of human subjects. The software for that is quite different to the type of software that we have, and there are some very large, successful competitors or players in that space, and we believe it makes little sense us trying to enter that market. Our regulatory solutions reach, however, although largely focused in the non-clinical area, so before human testing, does have application, and we have aspiration to offer that right across non-human and human testing. And informatics, the the use of large volumes of data. The data that we are leveraging might come from all phases of this life cycle. So information you are learning or have learned in the past, from the early stage of discovery right through to information that you have learned from drugs that have been on the market for many years, and there is efficacy and safety related information for those drugs. Overall, one of the huge aspects of return on investment for our clients in utilizing our products and services is our ability to help them shorten this period of how long it takes to bring a drug or a medical device to market, from patent registration to market. Patent life, as you know, is 20 years. If it takes you 12 or 13 years, and if you spend, as it says at the bottom of this slide, somewhere over $2.5 billion through the R&D process, you then have 7 years of patent protection before you will have generic competition, and you need to recover all of that R&D spend and make a profit. So if we can help the clients reduce that 12 or 13 years to 10 or 11 years, the return on that investment is huge. So I said we'd come back to leading market position. So we have a number of products and services within our portfolio. For most of those, we are number one or number two in the global market. We will sort of talk a little bit about that in win rates on this slide. But one of the reasons that we've been so successful is the investment that we've made at quite a lot of expense, I must say, over the last 10 or 12 years in putting in place a global infrastructure. This is very much a global market. If you are one of the top 10 pharma companies worldwide, you will almost certainly be doing R&D in Europe, in North America, in parts of Asia. You will want to deploy common systems in the areas that INSTEM provides systems, in all of those areas, and you will want to get the same quality of support for your people in Japan or China or mainland Europe or North America. And these are big, sophisticated enterprise applications, and for us to give the clients that quality of support, it's really important that we have people that are in their time zone, ideally can speak to them in their language. And that goes from all stages, from initial marketing to people, salespeople, service delivery people that are helping people deploy, configure, and get these systems operational, and then the support people that look after these clients through their life. That is a major differentiator, that investment we have made in people and offices in the UK, the US, France, China, India, Japan. The only area that probably might stand out there as not being represented is South America, but for the particular applications that we provide, that is a relatively minor potential market opportunity. Our success and our view of our position as a leading provider, as a number one or two, many of the application areas that we are in solution areas that are quite mature, things that clients have been buying for 20, 30 years. INSTEM as a business has been operating in this space just over 50 years. And we have clients that go back to when INSTEM very first started with these solutions in the very early 70s. We hang on to our clients very successfully. We report on an annual basis against a KPI that we have, which is to have our recurring revenue, annual support and maintenance, or software as a service subscriptions, to retain that at a rate of over 98%. And for FY 2019, where we comfortably beat that target of being over 98%. That's great for the clients we've already got, but the strong win rates tell us, how successful are we today in the market. And in that area, our win rates, they do vary a little bit from product to product or service to service. But in the period 1st of January 19 to the middle of June 2020, so just under 18 months, we won 54% of all business we quoted for. We lost 14%. And the balance is opportunities that we have classified in our CRM system as gone away. So areas where the clients have said, whilst we were interested, it's not actually going to be something we invest in this year. Maybe it's something we'll buy next year. So very strong existing market share, very strong win rates competitively. What that means is we have amassed a very prestigious client base. We have over 500 customers. Actually, we have well over 600 customers. The reason we haven't updated this to be more than 500 is that it was a number that was slightly easier to verify when we did our fundraise recently. That includes all 25 of the world's largest pharmaceutical companies. It includes 18 of the top 20 non-clinical contract research organizations. And you may be aware that the pharma industry is increasingly contracting out the studies that it undertakes, particularly the regulatory studies that produce data that need to be submitted to the regulatory agencies, to the contract research organization market. That's a rapidly growing market. It accounts for a huge proportion of the work undertaken today. And if you want to be successful in the areas that we operate, you need to not only have pharmaceutical customers as clients, but also the major CROs around the world. We could present many slides that talk to the market dynamics in the areas that we do business. We have found over the years that this data, and it comes from a report that is issued each March, and it's the Pharma R&D Annual Review. This is the data from March 2020. And we have pulled out the most useful data out of that report. It's a freely available report. You will be able to get it yourselves. The chart on the top right is the total number of drugs in the global R&D pipeline. So as of March 2020, there were 17,700 drugs in the R&D pipeline. They were actually shared by somewhere just over 4,000 companies. So the biggest pharmaceuticals will have multiple, and then there will be virtual pharma companies or biotech companies might just have one. In years where the total number of drugs in the R&D pipeline is growing nicely, as it has over the last 4 or 5 years, and has grown particularly strongly from 2019 to 2020, almost 10%. The more work that's going on, the more necessity there is for INSTEM solutions. Most importantly is the chart below. About 85% of our revenue comes from the preclinical or non-clinical area. So this is work that is undertaken on cell cultures, on tissues, on animals before drugs are allowed into humans for the first time. Because 85% of our revenue that comes from this area, the more drugs and the greater growth from one year to the next. In this phase of R&D, that is even more predictive of INSTEM's revenue fortunes. And that actually grew a little over 13% from 2019 to 2020. And of course, the bullets on the top left, the reason that the pharma R&D world is willing to put so many R&D drugs into the R&D pipeline is because there is huge demand around the world. People are getting older, their needs for medicines are growing, developing economies are becoming wealthier and can afford to pay for drugs. Some of those economies may be can't pay as much as they would like to pay for drugs. So China is a good example. If you have a population of 1.3 billion people or thereabouts, paying Western prices for drugs is problematic. So China has its own domestic R&D programs, and all of that is contributing to new market opportunity for INSTEM. So, some recent news flow. On the basis that you've come onto this call, I'm assuming you may well have read a half-one trading update. I won't talk through all these bullets. The great thing is organic growth up 12% if you include the acquisition that we did in November of last year, and we have the first 6 months of revenue for the first time. Revenues are up 20%. I'm sure you will also have seen that we have recently completed a heavily oversubscribed fundraise, raising 15.75 million gross, 15 million net, to support our M&A strategy. We're going to come on to talk more about M&A, so I won't say any more about it on this particular slide. With that, let me turn over to Nigel, who will talk a little bit about some of our financial information.
Thanks, Phil. So this first slide just gives a snapshot of our results for the year ended December 19 compared with December 18, which you can see in the smaller numbers below the circles. I think I'm pleased to say that all of those key metrics we've improved on year, and that obviously is our intention to continue to grow each of those areas as well as we move forward. A little bit more information on the next slide about each of those areas. So on the revenues, we've got a couple of slides coming on regarding revenues, so I won't go into too much detail here other than to say our recurring revenues of annual fees and software as a service represents about 60% of our total revenues and continues to grow. We do put our or the impact of foreign exchange on here, where our primary exposure from a trading point of view is US dollars. We had an positive impact of just around about 600,000 in the year to December 19. But we do, because of our US operations and our cost base in the US, we do have a natural hedge against that. So actually the impact on our results at a profit level for 2019 was actually minimal, just under £100,000. The majority of our cost base is people related. So as you can see there, 65% of our total costs are payroll or something similar. We have just over 300 people work in the business globally, and we've continued to invest in our staff over the last couple of years. As you can see, a more than average increase in the payroll cost, but nevertheless, we now have a base and an infrastructure where we believe it's a great platform in which to grow the business rapidly. Our margins at a percentage of revenues are just under 19% in the year. We have a short-term target of hitting 20%, medium-term target of 25% and beyond. The numbers at the bottom regarding cash, probably worth mentioning. We had a very good year for cash generation in 2019, and that enabled us to use our own resources when we made the acquisition of LeadScope in November 2019. We paid 1.3 million initial consideration for that, and the other expenditure in that line there is our research and development cost of around about £3 million in the year, of which we capitalise 1.7 million and expense 1.3 million. And the cash at the year end, £6 million, and as we said in the half year results, that's increased to £9 million, and that excludes the fundraise that we've just recently been successful in obtaining. Next slide is analyzes the revenues geographically. So in the pie chart on the right hand side, you can see that the majority of our revenues are generated in the North America region, and that has been a feature of our business where the majority of our customers are, the majority of our opportunities are, and has been a very solid contributor over the years, as you can see on the 5-year spread on the left-hand side. The rest of the revenues are spread fairly evenly across those three areas of the rest of the world: the UK, rest of Europe, and rest of world generally. And in terms of the growth of those revenues, rest of the world, whilst being relatively modest in terms of its starting point in 2015, has grown the most rapidly over those 5 years, primarily from China, Japan, and very recently we announced a nice contract win in Korea. This slide shows the revenues by type. So in the left-hand side, various shades of blue, but you'll see the annual fees and software as a service, which are our recurring revenues at the bottom and top of those bars, are very significant in terms of contributors to our cash and profitability and our visibility on our revenues in the years ahead. And the growth really over the last few years particularly has been on the SaaS, as we move our existing customers to SaaS and our new customers to SaaS wherever possible, and significant growth in our outsourced services, as you can see there at the bottom right. The final financial slide is just to put into perspective the three areas of the business that Phil was mentioning earlier on. So study management and data collection is the largest proportion of our business. This is where most of our recurring revenues are, most of our cash generation, and the growing, very significant, important part of our growth strategy is in our informatics, which, as you can see, is very modest as a portion of the total, but rapidly growing, and Phil will talk about that shortly, and our regulatory solutions, which again remains a very important, significant part of contributing to our profit and sales. Okay, thank you, Phil.
Thanks very much, Nigel. Oops, all right. We're both advancing slides at the same time. So, growth strategy, and it is an opportunity to talk about some of that mix in our business. Before I do that, though, we have this top bullet: management targeting significant revenue growth organically and inorganically over the next 3 to 5 years. So it's good to see from the poll that about 40% of you have attended an INSTEM presentation before. You might well have seen this bullet and heard us talk about the aspiration to grow from a business of roughly £25 million in revenue to £50 to £75 million in the next 3 to 5 years. When we've shared that aspiration, it wasn't with the expectation that we would necessarily be able to do a £15 million equity fundraise. So it is reasonable to say that from today, we would expect to be getting to £50 million in revenue in much closer to the 3 years than the 5 years, and we really do believe that that goal of £50 to £75 million in revenue is very much in our sights. I've mentioned the fact that we have invested very heavily, and Nigel's touched on it as well, on that global platform. We believe that is very leverageable. So from a sales, a customer support, and marketing, we think we could probably double our revenue and maybe only add 5 or 10% to the cost of that infrastructure. Clearly, for some elements of our business, there is a cost of sale requirement. So if it's something that needs people, we might need the people to go for delivery. But in terms of the sort of the G&A investment or F&A investment, that we believe will scale. In terms of growth, we see 3 areas of emphasis: organic revenue growth, and as Nigel said, the study management area, that is the most mature. Since we IPO'd, we've been guiding people to expect about a 5% or mid-single digit revenue growth year on year in study management. You will have seen that that's exactly what we delivered last year. That's what we've tended to deliver year after year. We do, though, have areas that have been growing much more quickly. So the send area, for example, has grown from nothing to £7 million or thereabouts over the last 5 or 6 years. Nigel also talked about the informatics area, which, although small at the moment, is growing fast. There was about 100% increase in revenue in that area from 2018 to 2019. Clearly, this is an area, as I talked about with the intro, where there's a huge appetite from the pharma clients to be able to leverage historic data to support today's R&D activities. There is a belief and quite a lot of evidence to support the fact that you can see things in trends in large volumes of historic data that are not exposed by today's cell culture and animal-based assays. So using data, you can make a material difference to your R&D success. So we see that area that is new, is just scratching the surface, where there is huge market appetite, as having the potential to grow rapidly. We have opportunity organically, but also this is an area where there are quite a lot of emerging businesses. One of those, not necessarily in this particular case emerging, is the acquisition that we did in LeadScope in November, actually quite a well-established business. But what's happening in the particular area they operate is that approaches that have been used in the discovery stages of R&D have now got enough credibility and provenance that the regulators are working closely with the pharma industry to apply some of those predictive analytics products in the regulatory stages of R&D, replacing animal and potentially human-based studies. So, big focus on organic growth. A focus on margin improvement. One of the key things here is around leveraging that expensive global infrastructure we have in place. The more revenue we put through, because we don't have to invest proportionately in those areas, the more of that revenue will drop to the bottom line. As we transition some of our solutions, so Nigel mentioned the drive to deploy more of our customers' software as a service rather than deploying these sophisticated enterprise applications on their own servers within their own facilities. By moving that deployment to our SaaS solution, we get economies of scale in SaaS, we generate additional revenue, and that can deliver increased operating margin. And then the third area, which we're going to come on to talk about, is accretive M&A, a really important element of our strategy. We have done 6 acquisitions since we IPO'd. We've done a couple of acquisitions before we IPO'd. The whole rationale here, as we will see in this and subsequent slides, is that the pharma and medical device, the life sciences R&D industry, IT supply to that space is very fragmented. Although we are, in global terms, a pretty small business with £25 million in revenue, or just a bit over last year, we are one of the biggest suppliers of IT and IT technology-enabled services to life sciences R&D globally. That puts us in a very strong position. Our clients have recognized that this fragmented landscape of suppliers is getting in the way of them optimizing how they undertake R&D. If you want to look at large volumes of historic data, if that data is locked up in the systems of literally hundreds of suppliers, it makes it very difficult, not impossible, but very difficult to aggregate it and derive insight from it. So the clients are encouraging consolidation. Many of our acquisition targets come to us from our clients saying, we have this great relationship with this business in, well, let's take one of our examples of an acquisition that we've done in 2016, a very successful business called Notochord, all of its people bar one in France. lots of clients, the clients came to us, several of them, and said, why don't you acquire Noticord? Why don't you give them the global platform to market, sell, deliver the services and support customers worldwide? Because we get great support from Noticord in mainland Europe because all of their team is in France. We get terrible support from them in North America, where they just have one person that's trying to do marketing, sales, service delivery, and customer support. So part of the rationale here, driven by the clients and the ability for us to be able to take really successful businesses and help them scale using our global platform. A little bit like the organic growth story, if we can accelerate our revenue growth, put more through that global platform, that will enhance our EBITDA margins. So one thing that we haven't talked about, and there's an opportune time here in the second bullet, is up until about 3 or 4 years ago, INSTEM was a 100% software business. And then a few years ago, after we'd been selling software in our portfolio that is less to do with managing the workflow of activities in a laboratory and is more to do with the manipulation of data, clients came to us and said, look, we really like this technology. We could license it. We could do the work that this software supports internally. But actually what we'd like to do is to send you our data that we've collected and for you to do that manipulation on our behalf using your technology and send us back perhaps a submission-ready data set to send to the FDA. And initially we said, well, it sounds great, but that's not what we do. We're a software business. And then we thought about it and we realized that this was potentially a great opportunity. So it has panned out. And so there's a second avenue for growth here, both organically and acquisitively, which is not just more software technology, but more technology-enabled outsourced services. And that helps enrich the size of the acquisition pipeline. When we look at acquisitions, and we've had these philosophies really ever since we IPO'd in late 2010, acquisition targets, we are expecting acquired businesses to be accretive in the first full year. And we are looking to ensure that these acquisitions can deliver a minimum return on capital employed of 10% straight away. And then as we realize revenue or cost synergies to grow that return on capital employed to 15% plus, which is similar to INSTEM's business as a whole. Because we have just raised £15 million, because the acquisition strategy is obviously very important to us right now, a little bit more about the characteristics of targets. So the 6 deals that we've done since IPO are all what we would describe as bolt-on sized targets, so businesses with $2 million to $5 million in revenue. There are lots of those out there. We can be serial acquirers of businesses of that size. However, as we grow bigger, doing something of that size doesn't move the needle quite so much. As you all know, it takes pretty much as much work to go through an acquisition process of a business doing $5 million as it does a business doing $20 million. So there is some rationale in trying to look to do more transformational sized acquisitions. It is true to say that the valuation of more transformational sized targets will be higher than the smaller ones. Often we have reached out to the bolt-on size, and the transformational size deals, and frequently the bolt-on size deals, we remain the only active acquirer. Those targets recognize that INSTEM is by far and away the most attractive home for their business because it ends up less competitive. We will offer what we believe to be fair valuations, but it's not hugely competitive. And so Valuations typically will be in a 5 to 9 times EBITDA range. Once you get to more transformational size deals, there are many, many fewer of those. They will likely recognize their scarcity value. It is much more likely we will end up in competition. So we are anticipating there that valuation ranges will be 10 to 15 times. It's also fair to say that the bolt-on size deals, it's rare that we get cost synergies. These are businesses that are generally pretty lean, not unusual for us to actually add cost so that we can develop revenue synergies with bolt-on acquisitions. For the more transformational ones, it's very likely that there will be both cost and revenue synergies. There was a question that was raised around, well, where can you give us a little bit more insight into where these targets might be? So this takes that same picture that we saw earlier on of where INSTEM solutions lie in the R&D continuum, and picks out some focus target areas that we've been looking where we think it would be particularly attractive to add to things that we already have, or to add some things in that fall in a similar space but would be entirely complementary to where we operate today. I'm not going to talk through them all, but it gives a little bit more insight into areas of focus.
Thank you very much, Phil, and thank you, Nigel. Oh, sorry, my apologies. Summary.
Just one more slide. So you're right there, Mark, but just on the cusp. So hopefully what you will have taken from what we've been through is that one market related slide that I talked about, where the amount of pharma R&D that's going on, as well as the discussion that we had about the move for people to outsource more of what they do, is providing some very positive structural drivers, which means the industry is spending money. We have a very large client base already. We generate high levels of recurring revenue, and that client base is desperately keen to take more from us. So we have a huge opportunity to cross-sell things that are already in our portfolio, or if we add to our portfolio organically and acquisitively, we have a very receptive audience. Overall, what we're saying is we have a huge opportunity of organic growth augmented by a great opportunity to continue our acquisition strategy. So with that, I have now finished, Mark. Thank you very much.
Well, at least people will know it's live, seeing that I've been halfway through your presentation. Phil, Nigel, thank you very, very much indeed. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But I guess just while the company take a few moments to review the investor questions that are submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. You'll receive a separate email notification from us when that is available. And I guess lastly, before I hand back to Phil and Nigel, I'd like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. And that's massively important. I would very much encourage you to do that. Phil, Nigel, obviously investors had the opportunity to submit questions before the event. We've got about 15 minutes before we wrap up, and I know you would very much appreciate feedback. So I guess we've got about 10 or so minutes to run through these. So if I submit these, if I propose these questions that we received before the event, and then perhaps we could try and drive to the questions that have been submitted already. Would that be okay with you guys?
That sounds great, Mark.
Perfect, thank you. Right, the first question we have here is how long roughly before we see announcements on acquisition progress, please?
So when we did the fundraise, this was the first question asked by everybody, keen to support us, but they don't want large volumes of cash to sit on the balance sheet unused. What we have said, and so I'm not giving anything away we haven't already said, is that we've got a very well advanced pipeline. We had one or two things that were quite close to agreement of LOI or heads of terms that would allow us to get into a process. And if we can, we would be working hard to see if we can actually put some of this money to use before the end of this year. Certainly what we're thinking is that money raised plus the cash we have on hand plus the cash generation will support our acquisition pipeline for the next 12 to 18 months.
Thank you very, very much indeed. A question we received is COVID-19 a net positive for activity in your areas of service offering, or does it just cause a reallocation of finite capacity in the R&D section?
It's really the latter. So, what we're seeing is that the pharma companies are, and you see quite a lot of this in the news as well, putting to one side some of the things that were in their pipeline and refocusing their internal resources and their external expenditure on COVID-19 related therapies and vaccines. And so that's what we're seeing. We're seeing some things come through that are brand new, that are moving very fast. And in fact, when they happen, it's not unusual for a client to say, we're desperately keen to get this submission to the FDA. Can you turn around this electronic submission data set, within just a small number of days? And our team are very motivated, as you can imagine, to help with that.
Thank you.
So the latter, not the former.
Thank you. Next question, is there scope for margin improvement?
Nigel, do you want to pick up on that one?
Sure. Well, yes, there is, absolutely. And as I mentioned before when I was speaking, that we have short-term targets of improving those margins. We believe that we've invested a lot of money over the years in our infrastructure and global offering now, and I think now's the time we feel that we can start to leverage that and drive the margins as well as top line growth. And I think that we're well positioned. We're bringing in or we're looking at target acquisitions that are going to enhance that as well. And so I feel that we've got a position now where we can start to take advantage of our structure and drive that. So absolutely is the answer, yes.
I mean, a good point, I suppose, and I'm sure you guys are sort of well ahead of me here, that there is published research available. We pay progressive equity research to produce research on INSTEM. We've had a long relationship with them. If you know those guys, just as we pay them doesn't mean that they're going to write nice things about us. They take their responsibilities very carefully, but you will find that research. You will probably know that it's harder to get your hands on the N+1 research that is produced on a regular basis, but maybe not impossible. And you will see that EBITDA margins on an organic basis, which is all that research covers, are up north of 22% in 3 years' time. So that's the analyst guidance, and that's a sort of level that Nigel and I and the management team are comfortable with.
Thank you very much. I guess the final question before we, turn our attention to those questions submitted today is, what are the company's growth expectations?
So, this was submitted beforehand. I think we probably addressed that as we went through. So 50 to 75 million pounds revenue-wise in the next 3 to 5 years, and EBITDA margins north of 25%.
Thank you. So I guess, guys, turning to the live Q&A, obviously, I think, again, you probably would have perhaps addressed some of these questions. And of course, just to remind investors that every question will be reviewed by the company after the presentation, and where appropriate, responses will be published to all investors. But perhaps I could just hand over to you, Phil and Nigel, I guess, just to pick out those questions where we can answer them. And I guess if you could just read out who they're from, followed by the question, so people can put it into context. Thank you.
Sure. So Javed, thank you very much. Why not use a small amount of debt to make acquisitions, given the reliability of the earnings stream? So it won't surprise you that this was also when we did the fundraise roadshow, a question that just about everybody asked. It was a massive fundraise roadshow, 45 institutional meetings. And it won't surprise you that those institutions have different philosophies on debt. some that would like us to have no debt, some that would like us to have more debt. Overall, what we have said is we're not averse to debt, but we see that there is no necessity, we believe, and we think we will stay within a nice sweet spot of investor desire if we commit to no more than 1 times EBITDA. With EBITDA last year at £4.9 million, that's a reasonable amount of debt. Obviously, we expect that to be higher this year, and obviously we would be able to do 1 times INSTEM's EBITDA plus the acquisition target's EBITDA. So if we need to, we will use debt, but not large amounts.
It's probably worth just worth adding, Phil, that we take advantage of sort of vendor debt really when we've made acquisitions, that as well as the cash consideration that we put out there, we try and combine that with some element of INSTEM paper, and then a deferred element of consideration, whether it be contingent or just deferred by time. And so at the end of, for example, the Leadscope acquisition has brought with it £1 million worth of deferred consideration, deferred and contingent consideration over the next couple of years. So, arguably that, there's an element of debt there as part of that structure. So just wanted to add that in.
Yeah, good point, Nigel. Thank you very much. Roger, thank you very much for this question. It's one that has not been uncommon because we've raised money before. Will the board consider allowing shareholders to participate in future fundraising? It's something that we spoke at some length to M+1 about ahead of the recent fundraise. As you will know, allowing non-institutional participation adds to the complexity and adds to the cost. And on the basis that we felt very positive about the demand that would be out there, and as a consequence, the fact that any discount to market price should be pretty modest, we felt it was wise to actually keep this to an institutional raise. You will know, as sophisticated investors, that there's a lot of businesses have been out looking for money. Most of them, because probably for no reason of their own, they've been badly impacted by COVID-19, and institutional investors have been generally pretty sympathetic and supportive. A small number of businesses in comparison, like INSTEM, that are pursuing money to support growth, not just keeping the lights on. And the advice was, let's not make it difficult to get institutional support. Let's make this process as easy as possible. So it's a longish answer, but we recognize it's a really important issue. And, as and when we can, we would like to allow private investors to participate, particularly if we perceived that it was going to be at a significant discount to current market price, which of course, in this particular case, it wasn't. And hopefully people that had an appetite have been able to step in and been able to get their hands on shares at a reasonable price in the aftermarket. So thanks for that question, Roger. There is another question immediately next from Roger, but I'll pick somebody else. So Trevor, thank you very much. You are highly profitable and cash generative with a strong balance sheet. Before the cash raise, what is your attitude to the payment of dividends? Nigel, do you want to pick that one up?
Sure. Well, we're very mindful of the fact that there are a number of investors that are looking for us to pay dividends. We IPO'd on the back of the ticket that was said we will consider it in due course when we felt it was an appropriate time. We're now getting to that time, I think, where we're getting that predictability of cash, and as you said in your question, that we have a strong balance sheet, we have growing cash. And I think we are now, looking to that seriously. Clearly, we've been able in the past to use our surplus funds and reinvest those into the business, making the acquisitions that we've made. But on the basis that we now have, good operational cash generation as well as the M&A funding as well. That's certainly what we're looking for. We took a bit of a hit in 2019 with our write-off of goodwill as an impairment non-cash item, but that's taken our retained earnings into a negative situation. So immediately we're not actually in a position to be able to pay dividends, but certainly as a board we talk about this regularly, and we will be considering it going forward when we're actually able to do that legally, of course.
Thank you very much, Nigel. So Sam, would attempts to reduce the use of animals in preclinical trials be beneficial or negative for INSTEM? We believe it will be beneficial. Ultimately, as this becomes more and more successful, it will reduce some of our study management revenue. But because we have been embracing this move, both organically and acquisitively, we see that in that sort of transition phase, and even after it occurs, as long as we go about this, deliberately and aggressively, that we can be net winners out of the move to reduce animal-based testing and to instead replace it with predictive modeling and data insights. So, great question. Thank you. The next one was Gareth. Given the growth of China as a developer of new drugs and its increasing importance to the market overall, how do the large Chinese pharma companies interact with CROs, and do they use them in the same way as Western big pharma? So, yeah, great question. Thank you. And because those Chinese pharmaceutical companies are generally much younger than the Western pharmaceutical companies, they have embraced outsourcing to CROs from the outset. So, although INSTEM has been massively successful in the Chinese market, having set up there 10 years ago, we have very few Chinese pharma clients as direct clients. What we have is just about all of the Chinese CROs, because that CRO market has grown rapidly as China has spent more and more in R&D. So it's disproportionately a CRO market at the moment in China, and as INSTEM is very successful with CROs, we've been able to replicate that in the Chinese market. So, good question. Paul, a bit of detail on what forms third-party costs and other expenses. These are great questions. They're nicely alternating between Nigel and I. So, Nigel, do you want to pick up that one?
Thanks. So the third-party costs are primarily hosting costs. So that's part of our hosted platform for our software as a service offering and hosting generally. So they fall into that category, as well as costs that we incur when we pay third-party suppliers of software that form part of our software offering that we sell to our customers. So that tends to be the majority of the third-party costs. Other expenses generally are, other than our payroll costs, which I was saying before, our majority of our costs are just general overheads. We lease all our offices worldwide, so those costs, form part of our other expenses as well. But just general other overheads. Nothing significantly different than any other organisation, I think, in our sector. Okay.
Thanks, Nigel. I'm guessing, Mark, that we've just got probably 30 seconds to go, so maybe
feel
we will
free.
have to hold answers to the remaining questions.
Yeah, absolutely. Maybe if you just want to pick another one, and then, of course, as we said, we'll review all the questions post the meeting. But yeah, over to you.
So, Bastian, so thank you very much. Who is your bigger competitor? So, across our portfolio, because it's quite broad, we have quite a number of competitors. Picking somebody out that competes in several product areas, I would say, well, actually, it says bigger competitor. I might be misanswering this question. So it's a company that's smaller than us, has less market share than us, but the company we compete with most, and of the relatively modest amount of business we don't win, they win the biggest share of it. And it's a company called Xybion, X-Y-B-I-O-N, headquartered out of New Jersey in the US. Actually moved to Pennsylvania now, Pennsylvania in the US. They are in study management in the non-clinical area only, not in the early phase human trials, and they are in the regulatory solutions area, at least the part of it that is associated with submissions during the R&D process to the regulatory authorities.
Thank you very much indeed, Phil, Nigel. Look, I haven't even given you an opportunity to perhaps wrap up, just to conclude, and then perhaps I'll take back and then redirect investors for feedback.
Yeah, Mark, thank you very much. Thank you very much, everybody. Thank you for your great questions. It was great to see that I think it was 60% of you are existing INSTEM shareholders, so 64%. So thank you very much for that. It's great to have this opportunity to engage with you, to take your questions. We look forward to more opportunities of this type. Stay safe and well. Thank you very much. Over to you, Mark.
Thank you. Thank you, Nigel. Thank you, Phil, for updating investors today as part of your roadshow. Could I ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide feedback? And I can't emphasize enough how important it is to hear the view of all shareholders. The company does hear from its biggest shareholders. I think also equally important is the view of the smaller shareholders. So please do provide feedback. If you access this meeting through our website, the feedback form will appear, and would encourage you perhaps to consider coming through that way. Alternatively, if you came in using the email link, then you'll be asked to log back in and the feedback form will appear. So thank you for that. On behalf of INSTEM, from Phil in the US and from Nigel in the UK, and us at Investment Company, thank you for attending today's presentation. That concludes today's session.